Hello, students. Today we are going to learn part 3 of business studies, and that is chapter 8 Sources of Business Finance. We are going to understand few basic concepts, and the first one is trade credit. So, you need to understand what is trade credit, which is again one of the sources of business finance. It is the credit extended by one trader to another for the purchase of goods and services. So, when creditors grant such facility, they are in fact financing purchases for a short period. So, this is the most convenient way of getting business finance. Let's talk about certain merits of trade credit. The first one is very convenient source of financing because you already know your co-trader and you can get the finance from them. So it is a convenient, it is readily available because there are no such legal formalities or documents which are required. And it also helps you to increase your sales and helps in maintaining higher inventory level. Because when you continuously borrow from trade itself, that is when one trader offers money to another trader, then it helps in maintaining higher inventory level. And there are no charges on the asset. But when we talk about the limitation, there are chances of over trading, that is, bulk trading than it is actually required. And limited funds only can be generated through trade credit because, in terms of getting finance from the traders, many a times it may happen that one trader, when you borrow from one trader, then they may not be in a position to provide you more fund. It of course involves higher cost because by charging higher prices. So you have to charge more in order to pay back to the trader as an interest. What is factoring? Now, a factoring organization is a financial service provider which specializes in collection and administration of debt. So a factor may be either an individual or an institution. So let's say debt collection, credit management is a very tedious and a difficult process for any organization, and it will take a long period of time. So in such case, this duty may be entrusted to an agency which is called as factoring organization, and they are specialized in collection and administration of the debt. They extend this financial advice or assistance or advance against the book debts and provide full protection against any debt. So factors do this service in return for factoring commission and interest on advance granted. There are certain services which are rendered by the factors. First is discounting of bill and collection of client's debt. Like here's the account receivable, that is bills receivable, are sold to factors at a discount with or without recourse, and they assumes all the risk on it. Example: SBI Factors, Commercial Services Limited, Can Bank Factors Limited are these are some of the financial institutions which are providing factor services. We have recourse factoring, that is, no protection is offered to the client on bad debt, and non recourse factoring, wherein factor assumes the entire risk. The second service which is provided by the factors is providing information. So, factors provide information about the credit worthiness of the firm. And, like, let's say, when advantage of these factoring could be cheaper funds than the other mean, you get instant cash flow by bills receivable, and it provides security for the debt. So no charge on the assets of the company, and client can concentrate on the core areas like production. Of course, factoring is expensive on invoices of small amount, and interest which is charged by factors on advances may be higher than the normal. So consumers or customers may not feel comfortable while dealing with the third party factor. Now let's understand what is lease financing. Nowadays, it has been treated as an important source of long term finance. So, it is an arrangement under which a company acquires the right to use an asset without holding its title. The owner of the asset is called lessor and the user is called lessee. So the lessee has to pay the lease rent to lessor for the use of asset. At the end of the lease agreement, the asset reverts to the lessor who is the legal owner of the asset. When we talk about merits of lease financing, it enables the lessee to acquire the asset with a very little investment, and no such legal formalities or detailed documentation is required. So there are very limited formalities, and lease rent is charged against the profit. Hence, the tax liability is reduced. Lease financing also provides finance without sharing the ownership. So the risk of obsolescence on the shoulders of the owner of the asset. There are also certain limitations of lease financing, that is restriction on the use of asset. Normal business operation may be affected on non-renewal of the agreement, and if the lease agreement is terminated before maturity, then it may result in heavy loss. And lessee may not take much care on the asset as he never becomes the owner of that asset. Now let's understand what is public deposits. It can also be treated as a medium term finance by which the company may try to invite deposits from the public at a higher rate of interest than the commercial bank. They are issued for a period of up to 3 years, and the acceptance of public deposit by the company is regulated by RBI. Over here, less formality again, no security is given by the company, there is no sharing of control, and there are no charges on the assets. But it is not easy for a new company because only the company with proven track record will get good response. And it is an unreliable source. So we can say that poor response from the investors, and raising large fund is not possible through public deposits. Thank you.